Okay, here we are. It's 10:02. Sorry, folks. It's 10:02 on Tuesday, and it's time for our weekly webinar. So good to see everybody. We've got I hope another good topic tonight or today. We're going to talk about maximizing your tax brackets. This, of course, has come out of a conversation that I had with a client or someone who attended one of the one of our most recent events. So recently we had Ed Slott and David McKnight live at the Newtown Township Theater, or excuse me, Newtown Theater. And we've had some classes so far this year. So a lot of new folks we're talking to this year, as well as existing clients. So just want to welcome you all. And if you're just joining us for the first time, be sure to like, subscribe, and hit that notification button if you're first joining us on YouTube. And I want to break down how these Tuesday weekly webinars work. This is the live webinar. And then good morning, everybody who's saying good morning. Good morning, Jerry. This is the live webinar. So we'll talk about some IRA distribution updates from the Ed Slott group. I'm part of the Ed Slott Master Elite Advisor group. And we get great information from Ed and his team every year or every week, every couple of days, actually, it seems. And I'm always in contact with them, asking them detailed questions about how to do what's best for our clients from a tax efficient and tax planning point of view. And then we're going to talk about the markets a bit. And I have some follow-up from our discussion last week about the return differences in the S&P 500 and now the Dow Jones Industrial Average. So I think that's interesting, and we're going to build on that for our webinar, not next week, but the following week. So next Monday is Juneteenth, which is a federal holiday. So Tuesdays that follow federal holidays, we don't, or market holidays, really, we don't have a webinar. And I've shared it with you. It's much more difficult to pull together the market information that we'd like to talk about when Monday is a market holiday. And then we're going to go into our financial 15 or the financial planning topic, which today, as I said, is how to maximize your tax brackets. So let's get rolling here. And let me share with you, we have our new website has finally launched. So let me take a moment and I'm going to share that with you. So I'm going to pull up that. So this is what our new Attleboro Wealth website looks like. And if we go to the main page, and I'm going to be referencing something here in a moment, but you'll see there's a couple of things. And, our byline has been a different approach, a different strategy, and a new sense of confidence. We've had that for many years, kind of that mantra, but this highlights what that really means. So you can scroll through that. We've got some updated pictures of our team. It's great to see everybody. And then we took some pictures with David McKnight while he was in town. So we included him on our website. So I want to credit Dave for that. But there's a lot of things that you could poke around. I'm just going to, you can learn about our team. We've added our folks from Cornerstone onto here, as well as the lovely ladies who helped me do everything here, but also Scott Betton and Thomas Bayless, who many of you met at the theater event. And you can read more about our strategic partnerships. Here's Heather Schreiber. She should really be up here with the rest of us, but Heather is a nationally renowned expert in Social Security planning, and she's someone we engaged to review all of our clients' Social Security strategies about a year ago. So Heather's been a real asset to the firm as well. But you can poke around on here. There's a lot. I'm not going to bore you with all the information, but I do want to bring your attention to where you can find the recordings of the Tuesday weekly webinars. So they're all updated here live. So you can see the QCD details. This is what we talked about last week. QCD details, you should know, that's hard to say. Is your IRA protected against creditors? So you can just see that. So share this with your friends and loved ones who might have an interest in it. So there are your weekly webinars, and we have our live events and classes. That's kind of a coming soon page, but you'll see some information there. But then we have your special webinars. So special webinars is, we had David McKnight live a couple times in 2023. We had Heather Schreiber, who I just talked about at the beginning of the year this year. Long-term care planning we talked about. So these are more in-depth topics than even just our financial planning topics or our financial 15. So you can spend some time looking at those. Again, there's a lot of great information on this website. I'm really happy with how it turned out. It took a long time. We've probably been working. We started in June last year. We have another whole website that we're developing as well under Attleboro U, and that's going to be all the training and education material. Which there's a lot of videos on here already, but there's going to be more stuff, folks. So and we're going to refer to this today. So here's the slot corner. So I call it the slot corner because I want to give Ed and his team the credit they deserve. And you can see some information here. I talk a lot about this Master Elite Advisor Group. What is the Master Elite Advisor Group? So these videos talk a little bit about what that means, and this is a good one here. What is a member of Ed Slott's Master Elite IRA Advisor Group? So that's a good video to watch as well. But here's those downloaded materials, and one of the things we're going to access today is this orange chart. You see this 2023 tax planning. So you can access this. All you got to do is click on that button. You go in here and put your name and email address, and you're all set. And you can see that I tested it this morning. That was my personal email, so please don't start sending things to my personal email because I will not get it. But that's what that was. All right. So I hope that was helpful. And then again, our contact information, and we've got two different buttons for you to make things a little easier. So we've got for prospective clients who want to schedule a discovery call, you'll use this. And for existing clients, you'll use this button here. It often requires a lot of preparation if you're an existing client to do a financial planning appointment or even a review appointment. So we ask you to use that client link. If, of course, you need something immediately, just reach out to us and we'll accommodate you for sure. But I'm very happy, very proud of that website, and I hope you find it helpful as well. It's the same URL at attleborowealth.com. If you see anything that you think that we should add or change, let me know. I'm always open to feedback. Thank you. All right, so moving on here. Let me get this out of our way. All right, other upcoming events. So that's a new website. We're sponsors of the Newtown Theater. I love that little gem that we have in Newtown, and I was asked if I would sponsor, or if our firm would sponsor, a series of movies all summer long at the theater, and I agreed. And it's this really neat project called the Cult Vault. So some of the movies that they're going to have are The Army of Darkness. That's tonight. Actually, it's every Tuesday night. I think it's every Tuesday night throughout the summer. But Raising Arizona, The Big Lebowski, and we're planning a special event around The Big Lebowski. So we're planning, that's June 27th if you want to save the date. But we're planning a happy hour for clients where we can come before the movie and then enjoy the movie. All the tickets to these movies are free to the public because we're sponsoring it, so we're covering the cost of it. So I'm really, really proud and happy to do that. But it continues with Clerks, and this is Spinal Tap, Escape from New York, Tremors, and then ends August 15th with the movie 300. So that's kind of fun, and I'm glad to be able to do that. I did tell you there's no webinar next week on June 20th. We'll follow up the following week. All right, just checking my headlines or my notes here. So we talked about the planning topic today is maximizing your tax brackets, and we'll get to that in short order. Well, the big headline today is the Consumer Price Index came out at 8:30 today, and this is from the Wall Street Journal. Writes for May showed prices rose 0.1% from April and 4% from a year earlier. So the inflation is year over year is now 4%. Core CPI, Consumer Price Index, however, remained elevated at 5.3%. But both of those numbers, 4% and 5.3%, are in line with expectations. So it's likely. I honestly didn't see what the market open was, but I know the futures were up. So we'll see where, we can go into it saying it's likely that this will mean the positive market today, but, we're often surprised. So we'll see where we end today. All right. All right, let's move into our Ed Slott group updates. So the first is going to be from the Slott Report mailbag. So Sarah Brenner, writes this, and I'm going to share my screen here. So Sarah Brenner answered it this week. And of course, the mailbag is when people write into the Slack group to ask questions about particular things that are happening with them. And if you're watching a lot of these videos, or if you're attending live often, as many of you do on the weekly broadcast, you see a kind of a pattern. People are asking about inherited IRAs and rollover IRAs, and they're getting caught up in these traps along the way. And they're really not traps that anybody sets. They're just traps that you find yourself into if you don't know the rules. So let's talk about an inherited IRA first. So here's the question. I inherited an IRA from my brother back in 2019. I have been taking required distributions from it each year. Can I do a qualified charitable distribution from this inherited IRA this year to satisfy the required distribution requirements from this IRA? So we talked a bit about QCDs last week, but I don't think we touched on if you can do a QCD, or qualified charitable distribution, from an inherited IRA. So just as a recap, a qualified charitable distribution is when you take money directly from your IRA and you send it right to a qualified charity. And if you meet the requirements, then you don't pay tax on that money, right? It doesn't even hit your tax return. It just goes right to the charity. So Sarah's answer reads, it is possible for a beneficiary to do a qualified charitable distribution, or QCD, from an inherited IRA. You must be age 70 and a half. Remember, I talked about that quite a bit last week. And the maximum amount that can be taken for 2023 is $100,000. A QCD can satisfy a required minimum distribution from an inherited IRA. So really great answer, and something that isn't talked about enough, because, one thing that we can't do when we're doing tax efficient planning is we cannot convert money in an inherited IRA to a Roth IRA. But this may be a way after you're 70 and a half to move funds out of a inherited IRA that you're not going to have to pay tax on forever. If you're charitably inclined, it may make sense to move that money right to a charity, and you won't have to pay tax on that. Next question. I have a client who's interested in having his IRA purchase a vacation home. Can this be done? I see this all the time, when I'm scrolling through YouTube or Instagram or something like that. People say, never buy another piece of real estate without it being in your IRA. And they make really great claims about this, but you want to talk about traps. There's a lot of traps in that situation. So let's let Sarah talk about some of them. An IRA can invest in real estate, she writes. It is an allowable investment. However, your client should be aware that there are prohibited transaction concerns with using his or her IRA to invest in a vacation property. So particularly, this person asked if they could invest in a vacation home. The prohibited transaction rules do not allow you to personally benefit from investments in your IRA. That would mean that your client or his family could never use his vacation home. He also could not do any work on the home, such as repair work, without violating the rules. Investing in IRA and alternative investments such as real estate, while allowed, comes with additional risks and complications. Your client should understand these factors before deciding to move forward. So what happens is if the IRS finds that there are prohibited transactions. Now, I want you to think about how easy this could be triggered. You purchase a condo, and let's say you're not even using it for a vacation home, but it's just an investment property. And you purchase a condo wherever, let's call it the Jersey Shore, and you just want to use it for investment, and you purchase it in a self-directed IRA inside, as an IRA. And then you need to pay taxes for the year, and there's not enough money in that IRA to pay the taxes. You say, okay, my taxes are $10,000. I'll just write that out of my checking account and we'll all be good. Well, unless you're able to contribute $10,000 to that IRA and then write the taxes from the IRA, you've created an issue for yourself. What if you need a new roof, and that also would cost $10,000, and there's not $10,000 in that IRA? Well, you have that same issue. You can't just write it out of your checking account. You first have to be allowed to make a contribution to the IRA. And you cannot make a contribution to an IRA for $10,000 yet. I'm sure it'll get there at some point, but you have to meet some income requirements, right? And you got to have earned income, things like that. And it could be it doesn't have to be a deductible contribution. I don't want to get into the to the details of it, but you can see that it is kind of loaded with little landmines. Spousal rollovers. So this is also from Sarah. So the question is, this is not a mailbag. This is just one of her reports. So she writes, probably the biggest advantage that a spouse beneficiary of an IRA has over other beneficiaries is the ability to do a spousal rollover. Only a spouse beneficiary can do a spousal rollover. Non-spouse beneficiaries do not have this option. With a spousal rollover, inherited retirement account funds become the spouse beneficiary's own. So it's no longer an inherited IRA. They treat it as their own. How a spouse rollover is done. A spousal rollover can be done by rollover, direct transfer, or by the spouse beneficiary treating the inherited IRA account as her own. All three of these methods will achieve the same end result of a spousal rollover. A direct transfer of the inherited assets is the safest way to get a spousal rollover done. It avoids the rules and potential pitfalls that come with a 60-day rollover. If the deceased spouse died on or after his required beginning date, the year of death RMD must be taken before a 60-day spousal rollover is permitted, but an RMD can be directly transferred to another inherited IRA and taken later in the year. Here's an example. Let me make sure I'm not blocking. Yeah, we're good. Example, Jake, age 75, dies in 2023 without taking his RMD. His spouse, Gwen, age 68, is his beneficiary. Gwen decides to do a spousal rollover, and she transfers the inherited IRA to a new IRA in her own name. She can transfer Jake's entire IRA, including the year of death RMD, to the new IRA and take the year of death RMD later in the year. In 2024, Gwen will not need to take an RMD from the new IRA because it's considered her own IRA and she is not yet 73. That's an example of where this may make sense to roll it over and treat it as your own. When a spouse beneficiary treats an inherited account as her own, the surviving spouse essentially pretends as if she owned the deceased spouse's IRA account all along. This method of doing a spousal rollover is relatively uncommon, as many custodians do not allow this option. Consider a spousal rollover carefully, of course. While a spousal rollover is a powerful strategy, it should be considered carefully. This election is irrevocable. Once the funds are in the spouse's own IRA, a 10% early distribution penalty will apply if the spouse is under 59.5 when distributions are taken. There is no going back to an inherited IRA. So let me pause there for a second and explain that. So the example above talked about someone who was the deceased spouse was 73. The other spouse who receiving the beneficiary was 68, I think it was. And so what Sarah's talking about here is if someone's younger. So if God forbid I passed away today, my wife inherited my IRA, she would probably want to keep it as a spousal, as an inherited IRA. Because if she needed access to those funds for some reason, she could take distributions and, of course, pay tax, but she would not be charged the 10% excise because she's under 59.5. That's an important point. If, however, she chose to roll that IRA into her own IRA, which a spouse could do, a spousal rollover, into her own IRA, and then she realizes that, hey, I need to take $100,000 out of this IRA. Well, now it's her own IRA and she's still under 59.5. So she would not only pay tax, but she would pay the 10% excise penalty on that distribution because she's under 59.5. So that's a really same with divorce. When you inherited an IRA in divorce, there's a window there. It's different, of course, but there's a window there when you transfer those funds where you can access those funds without that penalty. Always tax. There's always tax on the only way you can get an IRA out of your money out of your IRA without tax really is a QCD that I can think of off the top of my head. There may be another strategy, but I can't think of one. But always tax. The issue is the 10% excise and how to do this correctly. But as Sarah writes correctly, once that's done, though, once it's moved over to the spousal IRA, it cannot be undone. However, if the spouse keeps it as an inherited IRA, they can change it to a spousal IRA at any time. So you can't go back and forth, but there's a lot of leeway as far as, if God forbid my wife passed away today, if I passed away today, also God forbid if my wife did, but as in this example, my wife could treat my IRA as an inherited IRA until she was 60 years old and then roll it over to her own. And then she wouldn't have that issue. So I hope that all makes sense. All right. I think that's it for the slot event today, or the slot information today. Let me double check here. Yep. Okay. So let's talk about the markets, folks. So big week today. We already talked about the consumer price index that came out at 8:30 this morning. And tomorrow is the producer price index. So I'm just going to read what the report reads. Inflation at the wholesale level gives indications of whether pricing pressures are easing earlier in the production cycle, which should eventually filter through to the consumer. So what that means is that it's kind of a window to see where we're heading for inflation. It's not always that accurate, but it's a pretty good indicator. So that's tomorrow. Tomorrow is also the FOMC announcement. So that's we get the word if they're looking at raising interest rates again. Everybody's kind of feeling that they're going to pause. This is the Fed, of course. Speculation, given the recent divide in the Fed speak, is that we'll get a hawkish pause, they say, skipping one meeting, but indicating future hikes are very much a possibility. So we'll have to see what they say tomorrow. Thursday is retail sales, and that's it for the week. Retail sales, of course, the report of retail sales. All right, let's talk about the markets. I'm going to share this with you real quick because I'm going to come back and talk about the difference between this Dow Jones Industrial Average. I hope you can see my cursor here. Dow Jones Industrial Average and the S&P 500. So last week I noted that, well, let's talk about the weekly returns. So for 1 week, and I share this Invesco, I like this format. There's actually 2 pages to it, but I like all this information. So I currently don't use any Invesco funds, but I appreciate the format that they put this out in. So they should get credit. It's rather nice and easy to understand from my point of view anyway. So you can see here, let me just make this a little larger. The Dow Jones Industrial Average for the week was up 0.36%, and the S&P 500 was up 0.41%, and they seem pretty close. But year to date, the Dow Jones Industrial Average was 3.26%, but the S&P 500 is up 12.81%. Year over year, they're not too far away, about 1.56% difference, but this is a big difference this year. So it inspired me, and you can see the other indices. So, up slightly last week. We have good amounts for the year to date: 2.720, 10.39, 5.87, 10.83. We still have this inverted yield curve. I'm over here on the right now, where interest rates are higher. You receive higher interest rates for owning shorter term bonds, and you do lower interest rates. So that yield curve is still what they call inverted. So that's not a positive economic sign. And you can see that the 6-month treasury, I'm down here in the middle, is at 5.35. And the last time I looked, the 3-month treasury, so that's a U.S. bond issued by the federal government, nothing safer than that. You'll get an annualized 5.25 or 5.24%, I think it was. So this is interesting. Bonds fell a little bit last week. I'm back over here on the left. See where this says fixed income. Fixed income means bonds. Equities means stock. The bond index was down about 0.15%, only up about 2% for the year. Year over year, still down 1.5%. This is where most people have their bond money invested, this U.S. aggregate bond index window, that what they compare that to. And that's why most people are upset about their bonds losing money, because they think that they've been told that bonds are more secure and you should have more of your safe money in bonds. And last year they were down anywhere from 3 to 18%, depending on the bond that you held. So I wanted to give you a look at returns and the differences, because let me go back and find the report that I had. So we talked about this last week, and I had our research group, Cornerstone Portfolio Management, Cornerstone Portfolio Research. They don't do portfolio management, they do portfolio research, and we've hired them to help us with research, development, and implementation of our own portfolios. We don't ship our clients' money out to anybody to manage. We manage them in-house, and we've got this great team that we engaged late last year. Cornerstone Portfolio Management's a team of 8 certified financial analysts who really do a great job in helping us research things that are important to us and develop portfolios that are beneficial for our clients. So this is what I did here last week. I'm gonna take me out of the picture, so we're not cutting this off. But I said to Cornerstone, I said, I'd like some research about that I can share with folks on a webinar about why there's such a difference, a difference between the S&P 500 and the Dow Jones Industrial Average, because many people think that they run parallel and they're often very, very close. But obviously, that's not the case this year when we have year-to-date numbers like we talked about. So let's look at the bullet items here. And we're going to talk more about this next week. I started putting together information to include for this week, but we'd be here for a couple hours. Nobody wants that. So the first point is the S&P 500 is cap weighted and the Dow Jones Industrial Average is price weighted. So they count the components in the indices differently, and they weight them. I shouldn't say count them. They weight them differently. And that's a significant difference, in my opinion. Of course, the S&P 500 has 500 different companies represented, and the Dow Jones Industrial Average has 30. So that's going to drive a difference as well. But I'm not seeing that the number is really what makes the difference in the return of the different indices. Now look at this next bullet item here, or the starred item. Primary difference in yield-to-date performance of the S&P 500 versus the Dow Jones Industrial Average has been the nearly 14.5% weighting difference in tech stocks, technology stocks, even though the tech names in the Dow have outperformed those in the S&P. Interesting. So they're saying that the tech names themselves in the 30 positions in the Dow have individually outperformed those in the S&P, but because there's a higher weighting in technology stocks in the S&P 500, then that's what's one of the reasons. And they say the primary difference that we're getting those higher returns in the S&P 500. And they continue to write here, the primary contributors to the return differences in the S&P 500 and Dow are technology, up 398, that reads basis points. So for the rest of us, that's 3.98%. And that's due to weighting difference. So just how they determine how much of the stock is considered in the index. That's what weighting is. And I promise you, we're going to talk more about that, not next week, but our next webinar. I had done a webinar about this probably a couple years ago. I went into the indices in detail, but it's time to do it again, I think. So communication is plus 2.14%. That's 214 basis points. That, again, to the rest of us, that's 2.14% to the S&P due to weighting and performance difference. So what they're telling you is, as part of this 14 or the difference in return, almost 4% is made up, or the weighting difference in technology. 2.14% difference is due to the weighting and performance difference in communication. Consumer cyclicals, another 1.14% to the S&P due to performance difference. Financial services, 0.51%. 51 basis points reads 0.51%. And then healthcare is another 0.47%. So I thought this was really interesting. I'm sharing this with you because it's a lot of detailed information. I know you can see the weighting differences they did. I can't send this to you, but you can take a picture of it, whatever you want to do. But I just wanted to share it with you, our own inside research. I thought it was really helpful, and they worked quite diligently on this. So I appreciate it from Cornerstone. Okay, a couple more quick market updates, and then we're going to move on. Let's see here. So interesting article from the Wall Street Journal, I think from yesterday. They said the Federal Reserve Chairman's big problem just got even more complicated. Jerome Powell finds himself working to avert a credit crunch and financial instability, which calls for looser monetary policy, right? So they're saying he's going to need to balance, of course, and this has always been the balance, higher inflation and tightening these tightening the credit markets by raising interest rates. Well, at some point, you've got to loosen that back up to allow people to start borrowing money again, because things are starting to lock up. Strains in the banking industry help explain why some central bank officials are leaning towards holding interest rates steady at their meeting this week. That's talking about tomorrow. Even though the economy and inflation haven't slowed as much as they expected, while Fed officials don't think a crisis is imminent, current and former central bankers say the Fed will face a more difficult trade-off as the stresses worsen. if they worsen. It writes, they say the economic expansion, the Fed's credibility, and Powell's legacy are at stake. Now, listen, there was also a really interesting blurb from BlackRock. I had to read this 3 times to make sure I was reading it right. And I'm pretty sure it's not a misquote, but it's interesting. So there was an Outlook forum with BlackRock, obviously a lot of information, but I just kind of broke it down to a summary here, and it's really their summary. But they wrote, BlackRock investment leaders at our June 6th to 7th Outlook Forum agreed the new regime of macro and market volatility is playing out. The consensus, granular investment opportunities abound even against that backdrop. Counting on broad market moves won't do now in their view. So they're saying, don't just count on the big, the big broad markets to carry you for growth. You're going to have to be more strategic, perhaps, in your investment philosophy. This is the sentence that piqued my interest. That shift comes as U.S. and European economies have entered recession. Let me read that to you again. BlackRock writes, that shift comes as U.S. and European economies have entered recession. That's an interesting statement, but we don't see central banks coming to the rescue with rate cuts. We see opportunities in relative pricing and structural trends. So unless BlackRock comes with a correction in that, they've said the U.S. and European economies have now entered recession. So interesting statement. A trade, I want to say magazine, but it's all online, called Think Advisor. Jeremy Siegel was quoted in there. So Jeremy Siegel is a very well-respected PhD in economics and from the Wharton School, writes a lot about the markets, also has a stake in a exchange traded fund company. So, he does benefit from potentially some of his recommendations, but Jeremy Siegel writes, bearish days aren't necessarily over. So bear markets are when the market falls. If you're not familiar. So they're saying, don't get too excited. He's saying don't get too excited about these numbers we're seeing right now, because the negative days aren't necessarily over for investors, despite the stock market's rally to achieve a 20% gain from its October low. So from October to now, the markets are up about 20%, technically entering bull market territory. So that's a signal for bull market growth territory. Bull markets is when you have growth in the markets, just to put it simply. And again, that was attributed to Wharton economist Jeremy Siegel yesterday. So and just another interesting take on it. Okay, so let's move into our financial planning topic, and that is how to maximize your tax brackets. All right, and so I'm just going to reposition myself so I can draw on this. So you're going to see me moving around. And if you're just joining us, this is the Financial 15, of course. All right, the Financial 15 is the last 15 minutes or so of our weekly webinar, and this is where we talk about our financial planning topic. And if you're just joining us on this section on YouTube, please be sure to like, subscribe, and hit that notification button. And be sure to share it with your friends if you think that folks will find this interesting. So let's start with the why. Why would you want to maximize your tax brackets? Many CPAs will say, and again, most CPAs are rear view mirror looking. They look in the rear view mirror of what you did last year, and they say, okay, we're going to report on this, and maybe you should make some contributions to an IRA or something like that to minimize your taxes. But it's really about what happened last year. And many CPAs, if they heard me say, well, if you're in the 24% bracket already, and you're interested in tax efficient planning, you might want to fill up all the way to the top of that 24% bracket. They might say, whoa, why would you want to do that? Well, why would you want to do that? Let's just give a quick, I promise, tutorial. Remember our buckets. So we have your taxable bucket, and you all are experts, and you know this now, tax deferred bucket and your tax-free bucket, or tax advantage bucket. And your taxable bucket is, we get 1099s all along for every year for interest, dividends, long-term capital gains, short-term capital gains, etc. And all that equals tax. You must pay tax every year, and we're going to touch on that a little bit. And tax deferred is your IRAs, your 401ks, 403bs, etc. All of those that you've promised to pay tax on at a later date. Now, we all know and we all believe, and we have the evidence and the math behind us that taxes have to be significantly higher in the future than they are today. And if you believe that, and if that's been shown to you, and you know, when people say, "Well, I don't know if that's the case," I always say, "Well, I've got about 12 reasons why I know that taxes have to increase dramatically in the future, if not double by 2030, around there. Just give me one good reason, one reasonable, mathematic, substantiated reason why taxes are going to be the same or less." And nobody can really I've never had anybody really be able to do that. So if we know that, so we want to identify how much money we should have in each one of these buckets, and what's the ideal amount. And then everything else should go into this tax-free bucket, right? Because tax-free is anything is truly tax-free is Roth. And again, tax advantage or tax-free, whatever you want to call it, or properly structured cash value life insurance. It's not municipal bonds. It's got to be free of, to be truly tax-free, free of state tax, federal tax, capital gains tax, and does not contribute to your Social Security being taxed. So once you determine how much you should have in this taxable bucket, most people say 6 months to 1 year of expenses. And some people can keep some money in this tax deferred bucket, absent any other income. You should have an amount that generates an RMD that is less than, is that we're going to be there? Less than that's greater than, okay, an RMD that's less than your standard deduction. And if you're able to do that, then you don't pay any tax on your required minimum distribution. Now, I talked about that in a video some time ago, a few weeks ago, or maybe a few months ago. And if you have a question about this strategy, then you should research that video. Everything else then, once you identify how much should be in your taxable bucket and how much should be in your tax deferred bucket, then everything else should be moved over to the tax advantaged or tax-free bucket. So then the question is, well, how do you do that? Because the cost of moving from tax deferred to tax-free and even taxable to tax-free or tax advantaged is, of course, tax. So you must pay tax to get to the tax advantaged buckets. My friend and mentor, Ed Slott, would say you want to move things from forever taxed, right? These are forever taxed. These two. To never taxed. I love that, but it really is never taxed again, right? Because you have to pay tax to get there. So this is where the art comes in. Many people say, okay, I get this idea of converting to Roth IRAs, and I'm not going to get into I could easily fall into that trap of getting into the details of that. But if you want to move money from your IRA to a Roth IRA, you can use this tool called conversions. We've talked about this in depth. The question is how much and for how long, right? That's kind of the art of it. So I want to talk about how we get there. So is that amount that you convert this year $100,000 or $1 million? You know, it's all dependent on what your needs are, what your tax situation is, how long you're going to be in that tax situation, and so on. So we're going to talk about that. So I hope you all understand the why you want to shift as much money as possible, the right amount, to this tax advantage or tax free, because anything you take out of here, these tax advantage buckets, is zero tax. Anything that you leave to your heirs that's in these buckets is also 0% tax. And if we know that taxes are going to significantly increase, you know, if your effective tax rate now is 20 to 22% and taxes double by 2030, and that's a really good point in time to pay attention to with the problems we have, economic problems we have in our country, then it's pretty easy to see that your average middle-class American is going to be in a 40 to 45% effective tax rate, probably by around 2030 or so. So if you're not comfortable paying tax at those rates or higher than where you are today, you want to come up with a plan to shift to tax-free or tax advantaged. Now, here are all the things we have to pay attention to, and we're going to get into this a bit. first of all, we're talking about taxable income. People often ask that is, well, am I basing it on adjusted gross income or modified adjusted gross income? No, we're talking about taxable income. So you've heard my theory about and my thoughts about your retirement team. You want a qualified CPA on your team. We're tax planners, but you want a good qualified CPA to help you with these calculations and help us. What the CPAs really do for us is help affirm those calculations. So that's good. So we're working on taxable income, not adjusted gross income or modified adjusted gross income. They come into play in other areas, but not for what we're talking about today. Long-term capital gains and qualified dividends are taxed differently, but still have tax due. So although they're taxed differently and they don't fall into the same calculation as your taxable income, if they're qualified dividends or long-term capital gains, if they're ordinary dividends or short-term capital gains, they absolutely are treated as ordinary income, and they fall into these marginal tax brackets that we have over here. We're going to talk about in a minute. You also have to consider IRMA, income-related monthly adjustment amounts. If you're over 65 years old or on Medicare, receiving Medicare benefits, you have to pay attention to income-related monthly adjustment amounts because it's an additional cost of taking the steps to be tax advantaged. We have developed a great calculator that helps with future tax and IRMA calculations, so we can walk through that with you. Other tax credits. This is a big one. How about the electric vehicle tax credit? Now, that's up to $7,500. What if that really made a change for you? If many people come and we're doing the financial planning, they say, I want to buy a car in the next 2 years, the next 5 years. Well, one of our questions we've added to our questionnaire now is that an electric vehicle? Because there's a potential tax credit that we may not want to interrupt, right? And if we go over now, the new rule this year says if you go over certain thresholds, then this tax credit begins to go down and it gets eliminated. So these are the things to watch out for. We talked about the why, and we talked about some of the things to pay attention to. Now, how do we calculate this? All right. So I'm going to share with you. This is the form that you can download from the website. Go to attleborowealth.com, go into the slot corner like I showed you, and you can download it. You should download it. I've got this on my desktop. Of course, everybody in the firm really has it on their desktop, and we review it all the time. So these are from Ed and his group. I always give him credit. He puts these together every year, and I really appreciate it. We're going to be focusing on these 2023 tax rates, and we're going to talk about capital gains rates. But I drew them out because one thing, and I meant to bring this to the group's attention last time when I was there, they've flipped this upside down, and I don't like it. They start with the lowest rate, and they go to the highest rate and ascending order. Is that right? I like it this way, where you start with the lowest rate and you go to the highest rate. So while the numbers are the same, and I wanted to show you where I got the information, there's a lot of good information on this chart, not only capital gains rates, but trust tax rates. Gosh, this is so expensive. This is so important. A lot of people ask about trust. That's a big one. Standard deductions, this is in here. Qualified charitable distributions, good information here. And then there's some Roth conversion planning ideas. So that's always good too. But let's focus on these tax rates. So let me change my color of my pen for a moment. We'll make it green for money. I like that. So we've got two different filing statuses, married filing jointly here and single over here. Now the percentage tax rates, these are the percentage marginal tax rates. You'll see that these are the same whether you're married filing jointly or single. So people will say, well, once you're single, your tax rate goes up significantly. Well, it does. Your percentage doesn't necessarily change. This doesn't change, but what you're seeing over here are income amounts. So these are dollar amounts. I put dollar, I put percentage, and I put dollar. But these are your taxable income amounts. So these are after adjustments, after deductions, whether you itemize your deductions or you have standard deductions, where you land, this is how you're taxed. And it's progressive. So from $0 to $22,000, if you're married filing jointly, you don't pay any tax. If you're a single filer, well, it's half of that. it's $11,000. And once you cross over $11,001, well, now that $1 is taxed at 12%. So unlike people say, I've now moved into another tax bracket, it doesn't recapture all of your income that was down here. I'm sorry, you pay 10%. Did I say 0? I think it's 10%. You pay up to, that's right. So you would pay that first $22,000 if you're married, or $11,000 if you're married filing jointly, or $11,000 at 10%. It's just that next bit. So if it's $12,000 or $23,000, it's taxed at 12. So I hope you understand that. We'll move on. So if, for example, you had, let's say you stop there and you're at $23,000 of taxable income. Well, it may make sense for you depending on your situation, because again, remember, we identify how much we have in these accounts, and then we identify how to get them over here to Roth and what that schedule should be, and what that tax rate is going to be. And this is why I say the gift of the Roth conversions is you get to choose the tax rates. So let's just move forward with this example. Let's just say you have $100,000 that you want to convert from your traditional IRA to a Roth IRA this year. Now, and your taxable income is $23,000, and you're married. You're married filing jointly, and we're going to add $100,000 to that. Now let's add this up, and let's just kind of come in where we think $100,000 might be, and we know that that's going to be into the 22% bracket. So you might say, all right, well, that takes me now through the 12 and into the 22. Well, that might be too much. If it's only $100,000, you might say, you know what, let's stop at the 12. Let's put a hard line on the 12 this year, and we'll move the rest of it next year. And that might be a good strategy for you if you only have a little bit to move in your IRA to your Roth IRA. You might be able to say, okay, I'm going to take it right up to the top of the 89, the 12% bracket. And then next year we'll have a schedule for moving the rest of it. And we won't even be into that. We'll be back into the 12% bracket, right? Because if you go up to 89, that's only going to leave you about, what is it, 50,000 plus if there's no growth in that IRA, but you've got plenty of room. And so you're going to convert most of that money to Roth. Yeah, Roth at the 12% tax bracket. So that's pretty good. But let's say that you have more than that, or you're concerned about tax rate risk, or you're married and your spouse is ill, and then suddenly you're going to be in this, these lower income thresholds, and you say, I want to push that right up to the top of the 22. That might be a good strategy for you too. So we push up into the 22% bracket, and we've got some Roth conversion being done at 12. And some Roth conversion being done at 22%. Now, what if you have $1 million in your IRA that you want to convert over time, or you need to convert over time, and you want to convert almost all of that? Let's say you can leave $200,000 in there, or your magic number in your Roth, or your traditional IRA is 0, and your schedule looks much different. You might want to say, okay, for just 2% more, so just 2% more, I can go all the way up to $364,000, and I'll convert some at 12, some at 22, and some at 24%. And that's going to give us a blended rate. And let's just average that. It's probably going to be somewhere about to 19 to 20%, and a blended or effective tax rate. So I hope that's all making sense. This is how you maximize your tax brackets. You figure out the amount that you want to convert from your Roth IRA or your traditional IRA to your Roth IRA. And then you do the calculations to figure out what works best for you. Now, remember, if you do it too higher significantly in the future, I'm not sure what's happening here. Hoping I didn't lose anything. Okay. That tax rates could be much higher in the future, or that you could lose your spouse during this. Now, I hate to tell you, but when you go into retirement together, one of you is going to pass before the other. As soon as that happens, your income thresholds change very quickly. Remember, we could go all the way up to the top of the 24% bracket to $364,200 this year in taxable income. That drops all the way down to $182,100. So if I'm looking at a couple who are in their mid 60s and early 70s, and I'm doing a Roth conversion strategy, that's always in the top of my mind, right? Not back here, but up here. That's always in the top of my mind, is that eventually one of these folks is going to pass before the other. It's very, very likely that one's going to pass before the other. It's highly unlikely that you're going to go at the same time. And as soon as that happens, really the following year, we have much lower thresholds. And when single people come to me to do Roth conversions, it is certainly more challenging to get this work done because we don't have the gift of the top of the 24 bracket, top of the 24% bracket at $364,200. So if you're inclined to move forward with tax efficient planning and you're fortunate enough to still have your spouse with you, boy, you've got to maximize those brackets. Don't be afraid of the 24. Don't be afraid of the 32, depending on the amount of money you have. But you certainly want to calculate that, right? And make sure that addition, that 8% more makes sense. 2% is almost a no-brainer. But hey, if you can get it done in the 22%, I'm back here. If you can get it done in the 12% bracket, all the more power to you. I think all three of these are really good options if you're considered middle class, because again, the average middle class American, we believe by our calculations, are going to be in the 40 to 45% effective tax rate, probably by 2030. So use these tax rates that we have now to your advantage. If you're married, finally, jointly, certainly take advantage of them. Don't be shy about pushing up. You want to do these calculations. Make sure that you're not triggering capital gains issues or IRMA. And we're going to come back to that. That's not IRMA. This is IRMA. And that should all be part of the calculation. But that's how you maximize your tax brackets. So I hope that all makes sense. Now, let's just briefly talk about long-term capital gains and ordinary capital gains tax. Now, this is calculated differently. I'm talking about long-term capital gains and I'm sorry, this is qualified or ordinary. It should be qualified. Qualified. Let's fix that. So long-term capital gains and qualified dividends tax. So that falls differently. They don't flow into this calculation. So if you have $100,000, let's say you do a Roth conversion and with your taxable income, you end up with $364,200, and then you have an additional $100,000 in long-term capital gains or qualified dividends. That doesn't stack on top of here. That's not what happens. That would be short-term capital gains and ordinary income or ordinary dividends. Yes, sorry. So they fall into that graduated cylinder, right? We refer to this as a graduated cylinder, kind of like the money flows in like a liquid does in science class. So ordinary dividends and short-term capital gains fall into that, but not long-term capital gains or qualified dividends. Long-term capital gains and qualified dividends have their own set of tax brackets. So it can be 0, 15, or 20%. Now, let's look back at this chart. And you can see here, they jump pretty quickly. So married filing jointly from 0 to 89,250. You don't pay any tax. This is modified adjusted gross income. Now I know it's confusing, and that's why you should have that team working with you. A single filer is 0 to 44,625. Once you cross over 89,251 to 553,850, you're at the 15% tax rate for capital gains, right? Qualified dividends and long-term capital gains. But pay attention to that asterisk. I'm going to come back to that. Married couples or single people, 44,626 to 492,300 at 15. Over $553,000 in modified adjusted gross income, you're at 20%. Again, for the asterisk, I'm going to talk about that. And over $492,300 for single filers, you're at the 20% tax rate for capital gains, long-term capital gains, and qualified dividends. So why do I bring that up? I'm going to come back to this asterisks. That's net invested income, and that adds another 3.8% on top of these rates. So this could be 20 plus 3.8%, and this is from the Affordable Care Act surcharge. Some people call it the Obamacare surcharge, but that could be an additional 3.8% for each one of these for long-term capital gains or qualified dividends. So pay attention to that, because even though that doesn't calculate into your Roth conversions or tax efficient planning, folks, if you have $100,000 in qualified dividends or long-term capital gains, and let's just use this section here. If you fall in this threshold, that is another 18.8% in tax. And the math is easy on that. That's $18,800. So that is an additional tax that's going to be paid. And whether it comes from this table here, right? I'm up here, or this table here, both of those come from your checking account. So you've got to, or your investment accounts or your money. So you've got to include that in calculations. I hope that makes sense. So what triggers this net investment income? So anything greater than, again, this is modified adjusted income, anything greater than $250,000 for a married filing jointly couple. That's this year. These can adjust as the tax tables can adjust. $200,000 for single filers, $125,000 if you're married filing separately, and $14,450 for trust and estates. Whew, okay. So that's a lot of information. Here's what I want you to come away with. It's the idea of shifting money from taxable to tax deferred to tax advantage. You can go this way. Is kind of a simple idea, right? It's okay. I get it. I identify what I need. Now I'm going to move that over to Roth. I'm going to move it over. Maybe cash value life insurance is part of your plan. I don't know. And you could figure out, we could just go up to here. You first had to figure out your taxable income. You first had to figure out, what your potential taxable income is going to be for this year. Sometimes we do it all at the end of the year, do these conversions all at the end of the year. Sometimes we do them throughout the year or early in the year, depending on what your income flow is. If we're not expecting bonuses, things like that, it's a little easier. But you have to consider these other costs. So any tax that comes from capital gains. It's a little easier, believe it or not, with short-term capital gains and ordinary dividends, because it flows into this graduated cylinder. But you've got to add that if your budget is $50,000 in tax, and you take it right up to the line so that you're converting enough to just generate $50,000 in cash, and then suddenly you have capital gains that you weren't counting on, and sometimes that happens with mutual funds, as many as you know, and you have no control over that. And now suddenly you have to pay another $10,000 or $20,000 in capital gains tax. Well, now you've blown your budget, and this is an area where people hit frustration. You can also trigger things like your IRMA might cost you more, and you don't understand, or it doesn't make sense the benefit of maybe paying more IRMA now and not paying it later. So that might be an effect on you. You might lose a tax credit, like we talked about. There's several tax credits, but this electric vehicle one is a new one. So while it might be simple, it's not necessarily easy. But I just wanted to give you some things to talk about. This isn't an instruction to say, okay, now this is how you do it. Go ahead. I wanted to impart on you the difficulty of this process and some things to pay attention to. So remember, married filing jointly as opposed to single filers, that's a big deal. That can be a reason to have a more aggressive schedule in Roth conversions, because you're both not going to live forever, and you're likely not both going to go at the same time. So one of you is going to be stuck paying higher taxes potentially due to the fact that the other person passed away. Don't be afraid to test the schedule, the marginal tax rates, to see where you're going to, that tax that you're going to pay based on that. Don't be afraid to feather it down. Also, there are plenty of times that I'm pulling people off the gas. Sometimes I'm pushing them on the gas, but there are plenty of times I'm saying to people, we don't need to go that aggressively. And folks, you have to look at this every year. You reevaluate it every year to see what your conversion or what your tax efficient strategy should look like. All right. It is now 11:02. I think we've said enough for today. Jerry, I can answer that question offline. Jerry's question is where the funds to pay taxes on the conversions come from, upfront versus paying from available cash. That depends on the individual, right? Where your funds are and how much you have to pay and what your comfort level is. I hope that was helpful. I'd love your feedback on that. I hope you all have a great week. I won't see you next week, but I will see you the following Tuesday. And we're going to talk about these different indices and what the heck they mean, the S&P 500 and the Dow Jones Industrial Average and the NASDAQ and how they're formed and how they're tracked and more about that. So look forward to seeing you then. Have a great week. I hope you explore our website a little bit. And if you have any questions, reach out at questions@attleborowealth.com. That's questions@attleborowealth.com. Take care.